Hi, everyone. This is Tony D'Amico. Thank you for joining me for this video today. Today, we're going to talk about the recent market volatility. We'll also discuss if there is a possibility of a recession. We'll also talk about the strategies that we're employing to help you manage these risks. And lastly, the opportunities at hand. All right, so let's jump in. We are recording this on January 28th, 2022. Fidado Wealth is a SEC registered investment advisor. I'll be reviewing information with you that from various sources that are deemed very reliable. And just as a reminder, past performance is no guarantee of future results. So at Fidado Wealth, we're really honored that we've been entrusted with 311 million of assets under management as of January 1st, 2022. Okay, let's jump in. All right, so the topics again, we're going to talk about the current volatility in the markets and talk about why the markets have been repricing, what we anticipate moving forward, and is there a concern of a recession? Again, what we're doing to manage these risks and what we want to focus on. And let's talk about why the markets have been repricing. So the markets have been volatile for about 4 weeks in a row. The stock market has performed very well, but that's been coupled with significant inflation. For 2021, overall inflation was 7%, but there are some categories that had very significant inflation. So for example, gas was up 49.6% last year, and meat, poultry, and fish was up just about 13% last year. There's definitely staffing shortages, issues with Omicron, people calling off sick, and supply chain issues. So all of that coupled with high demand for goods and services due to the strength of the US consumer. The Fed has begun to taper their quantitative easing. So they're winding down their bond buying program, which does also have an impact on the market. So the markets are kind of digesting and pricing in that information. So let's talk a little bit about why the Fed buys bonds. So when the Fed buys bonds, it actually pushes interest rates down. And that has a twofold impact. One, on individuals. It'll affect mortgage rates and other rates for individuals to take advantage of. So it spurs economic activity. And just as important, if not a little bit more important, lower interest rates for businesses allows them to borrow money cheaper and expand their businesses, invest into them, invest into technology, research, development, buildings, hiring, and those things. So all those things stimulate the economy. However, the economy has been very strong. So the Fed has begun to wind down their purchases of bonds to stop that quantitative easing. The Federal Reserve also announced that they're going to begin raising interest rates in March. Again, here they want to attempt to cool inflation and prevent the economy from overheating. So hyperinflation is not good. Historically has not been very good at all for an economy. This has been very interesting in a different scenario because we have a very strong economy. Individual consumers have a low amount of debt, are in a great financial position. So there's high demand for goods and services. So the stock market has done well in the midst of inflation. And then lastly, there's geopolitical concerns with what's going on between Russia and Ukraine and other geopolitical concerns out there. So these are some of the reasons that I believe the markets have been volatile, and taking this information and baking it into the current price of the market. So let's talk about, is there a concern of a recession? So under normal economic conditions, it's one where the economy is just steadily growing. Since 1950, the economy has been in recession only 13% of the times, which has been a total of 11 times, and has been in expansion 87% of the time. So you can see that, typically the economy is in expansion mode where it's experiencing steady growth. Now, we've had a significant amount of growth lately. So what typically occurs alongside a recession? So when we look at recessions, historical recessions, we see that the economy achieved close to full employment. The economy got hit by a major shock or surprise, one that cannot be predicted. And then policymakers made some sort of mistake, which worsened the scenario. And with that, let's take a look at how long recessions and expansions last. Just kind of a side note too on that last bullet point about makers making some sort of mistake which worsened the situation. I will have to say that I do follow the Federal Reserve and their comments, and they're they have fiscal and financial responsibilities for the economy. They are not a political arm of the government, so they're operating free of political influence. And the Federal Reserve, how they've managed monetary policy, has really developed significantly over the past 20 years, let alone 10 years. So very proactive with monitoring scenarios, adjusting things that they can adjust to do what they can do to keep the economy in a steady growth phase and not one of hyper growth or excessive inflation. So let's take a look at how long recessions last. So again, we know that recessions since 1950 have only happened 13% of the time. So let's look at this. So an average recession lasts 11 months. And that's these purple areas here that are in the negative. But if you look at these blue and tealish areas, the average expansion lasts 67 months. So while recessions are painful, expansions have been very powerful. You can see the change in GDP, the change in the S&P 500, and the change in net jobs added. So is there a concern of a recession? The current economy is very strong, but not bulletproof and has some vulnerabilities. Recession is a possibility, but not a probability. If it would occur, we believe a recession would likely be shallow and short-lived. There's no doubt that the economy is balancing a lot, like we talked about, employee shortages, supply chain issues. There's a lot underway to try to rectify some of the supply chain issues. The Fed is anticipating right now that it'll be the second half of 2022 when supply chain issues start to show, some improvement. And that kind of goes back to some of the vulnerabilities that the economy does have. There's several different things in play that could affect the economy. So should politics come into play in making decisions on how you're invested for your long-term success? So should who's in office come into play? So I'll review this with you. I've reviewed this with our clients each election period, but I think it's worth revisiting. So this is taking a look at research that was done by Vanguard, and it compared Democrat versus Republican presidents and what the average annual return was. So you can see here from 1853 through 2015, returns were identical, whether it was a Democrat president or a Republican president. So what we do see is there's some differences in returns when we look at partisan control. So there's 8 possible combinations of partisan control, between the presidency, the House, and the Senate. So since 1948, the worst case has been an 8.4% annualized S&P 500 return. And that's when there's been a Republican president, a Democrat House, and a Democrat Senate. Now, the point of that is the worst case is 8.4%. So 8.4% is not terrible for a return for the S&P 500. Some of the best cases was when one party had control of all three of those entities. So that has led to some of the best returns. Another question, again, I've dealt with this with multiple elections, but I think this is also very important. What typically happens is that whoever is president during the midterm elections, they lose seats. So they lose seats in the House and the Senate typically. So this shows you change in House seats by the president's party in midterm elections. So going back to 1970, so there was only 2 times where they gained seats. The party in power gained seats. So in this case, there's a Democrat president. So it's very likely, it's very probable, not a guarantee, that they're going to lose, the Democrats will lose some House seats. And again, this happens regardless of the party that's in control at the time for the presidency. So if we look here too at all the 8 possible combinations, again, the worst is 8.4%. The best was 18.3%. And let's just say hypothetically that come midterms that there's a Democrat president and Republicans have gained control of the House and the Senate. So you can see what that average annual rate of return was at that point in time. Now, having said that, the whole point of this is that whatever party's in office, whatever party's in the Senate, whatever party's in the House should have no forbearance on making decisions with the money that you have to live on the rest of your life. So let's talk about some strategies that we utilize to help you protect from these different economic risks. So one is diversification. You all have heard me talk about that over the years, and diversification is very important. You diversify not because of what you expect, but because of what you don't expect, what you can't predict, what you can't see. Asset allocation. Asset allocation refers to spreading out your money across different asset classes. So it, obviously bonds versus stocks, but even within stocks, for example, mid cap, large cap, small cap, US real estate, international, emerging markets, and all these things are performing differently at different periods of time, right? Rebalancing. So we rebalanced earlier in January to bring our portfolios back in band, and rebalancing is a systematic way of selling high and buying low. So we do that rebalancing on an ongoing basis to take advantage of volatility, whether that's volatility to the downside or the upside. Ongoing institutional manager due diligence. So I carefully monitor the institutional managers and the fund managers that we utilize, looking at their performance, comparing them to benchmarks, and reviewing that again on an ongoing basis. So I think it's important to note the portfolios were constructed very intentionally, very thoroughly. Comprehensive planning. So you guys know our focus is on comprehensive planning and having you have the complete financial plan, and not just including investment management, but having a retirement income withdrawal strategy, tax planning, risk protection planning, debt restructuring, estate planning, all those types of things. And really, it does take relentless discipline. So if there's one thing that I've learned in, being in personal finance for over 20 years and, having my own firm for over 10 years now, it really does take relentless discipline to manage a plan and manage the investments and to not deviate from that discipline at all when times are scary. So let's talk about the opportunities that should be focused on. It's important to note that we obviously can control what we can control, and sticking to your plan does not equal doing nothing. Debt restructuring. So if you do have a mortgage or other debts, now is the time to look at that. Interest rates are still very low. They've come up a little bit, but mortgage rates are still historically very attractive. It might make sense to refinance, and we're here to help you determine if that would make sense. Tax planning. So one of the things that we always look at when there is a market decline is potentially doing large Roth conversions. So it's better to do a Roth conversion while the markets are down, because you're converting securities typically and not cash. So if we can convert more shares at a cheaper cost and do that conversion while the markets are lower, then when the markets do rebound, you'll have more shares in that Roth account. And once the price per share goes up, you'll have a better result. So if we're helping you with Roth conversions of greater than $50,000 per year, it might make sense for you to contact us, email your advisor, and we can start a dialogue to see if that makes sense to start that conversion. Now, it's important to note, we have a playbook, if you will. When the markets drop, what can we do? What opportunities are there to enhance wealth, secure wealth moving forward? And the same thing when markets go up. When markets go up significantly, again, we have a playbook as well, and certain strategies that should be looked at that point in time. So investing, do you have extra cash that is not earmarked for an upcoming expense? If so, I strongly encourage you to invest those funds. Important to note that 401k limits, as far as how much you can contribute into them, were raised for 2022. So now would be a great time, if you haven't already, if you're maxing out your 401k at work, to increase it, to take advantage of the additional $500 a year that you can contribute. Do you typically make contributions to your IRA, Roth IRA, or other non-qualified investment accounts? If so, I would strongly consider making that contribution now to take advantage of lower prices. So again, part of that relentless discipline is to do everything that you can to buy low and sell high. I know that sounds simple. It's not, because it takes courage, it takes that relentless discipline, but you have to take advantage of these opportunities because they don't come by all that often. Do you have any assets with a tax loss? If so, it might make sense to harvest that loss, which could reduce your tax liability and reposition that cash in a more ideal investment. Are you planning to retire in the near future? If so, I think it makes sense to revisit your plan to ensure that you're comfortable with the plan, with the current economic conditions. Now, one thing I will state that for our clients that have a comprehensive plan, have taken a lot of action to really secure their plan, ensure they're diversified, ensure the asset allocation is optimal, all the steps that we take to for that retirement income plan, maximizing pensions, maximizing Social Security, coming up with a withdrawal plan, planning out expenses, looking at a distribution sequence, what should be taken from, what should be distributed from first, second, third, as far as that income source. All of those activities that we help, the tax planning, the risk protection. So with our clients, and when they have done that, and they have a good probability of success in their financial plan. We didn't have anybody, for example, in the spring of 2020 when COVID occurred. We didn't have to have any client change their retirement plans. We didn't have to have any client change their income either. Now, if you're considering a large purchase, it might make sense to consider the timing of that. But overall, we haven't had anybody that we've had to, any existing clients that we've had to tell, hey, you need to change your retirement plans. But it still makes sense to revisit the plan. I think that'll give you you'll know where you're at, know that probability of success, and then have that confidence to proceed. So we talked about making a major purchase. So if those funds are not in cash already, if those funds are still invested, it might make sense to reconsider the timing of that purchase. And do you have any other planning areas that we've identified to help you with that still need your attention? Other tax planning opportunities, risk protection opportunities, estate planning. So again, anything that you can do to further make your plan solid, more comprehensive, more integrated is always what we want to be focusing on. All right, so let's talk a little bit. We talked about rebalancing and how we manage distributions. So this is a snapshot of the 14 different asset classes in the portfolio over a 12-month period. And this was taken approximately in the spring of 2020 when bonds were doing well and stocks were down. So the orange lines are the bonds, the blue lines are US stocks, the red lines are international emerging markets. And you can see here, there was bond funds that were up at this point in time. So there was a bond fund that was up 15%, another one that was up 9%, 8%. And these are the returns before fees. But the point of this is that there were positions that were up. There was volatility with the stock market, but bonds were up. So when we're freeing up distributions, the software we use is very sophisticated. It's going to sell the winners first. And that's what rebalancing is. Again, so if you're taking a distribution from your portfolio because you're retired, it's going to sell the ones that are up the most. And really, when do you get a return on your investment? It's when you sell. It's not when you buy, it's when you sell. And so we're not selling off all of the positions, just the ones that are up the most and out of band. Conversely, if you're adding into the portfolio, you're going to be buying these positions that are down the most, right? The positions that are, again, out of band to the downside the most. So that's why, again, strongly encouraging you, those that have cash, now is the time. And again, you have to have that opportunistic mindset. And that's what happened, after COVID. So again, we didn't have to adjust incomes or adjust the income amount for any client. And we had a lot of clients also too that had cash on hand that jumped on the opportunity. And since then the market's rebounded, so they benefited from that. Now this is a screenshot, during the fourth quarter of 2021 before the volatility ensued. And you can see there was stocks that were up significantly over this 12-month period. And the bonds, right? The bonds were not our friends, right? They were all kind of flat or down a little bit. And that's what a good portfolio, right, is. We have these funds that each have a high degree of asset class purity. These funds, we don't want them to overlap. They're not correlated. We don't want them to be perfectly correlated. We want this dispersion. Your portfolio is built for rainy days. It's built for sunny days. There's even some positions in the bond part of the portfolio that are very conservative. So we have a lot of different places we can go to for income or purchasing opportunities based upon the current market conditions. Now, this might sound simple to you, but I think this is very important. We just recently met with a prospective client, and their portfolio was not diversified at all. In fact, they had 80% of their portfolio in one type of investment. That investment was down significantly. Okay. And so we told them that they couldn't retire. So, we get, I share that with you just because I feel like we get used to being diversified, but there is benefits to being diversified. It doesn't make investing easy. It doesn't make it investing fun because you're seeing the total value go up or down. But again, what matters the most is, are you selling at a gain? Are you buying something? Are you buying the lowest assets at that point in time? And rebalancing and is what ensures that. So we talked about asset allocation. This looks at investment grade bonds and how bonds have shown resilience when the stock markets are unsettled. So these are different corrections that have occurred, and you can see bonds maintained a positive rate of return. So 97% of the time, bonds and stocks will move in random or different directions, which is important. Also, just a reminder, we expect volatility. So this is from 1949 to 2020. The S&P 500 has declined 10% or more on average once per year. The average length to recovery is 112 days. So again, we don't have clients that are 100% stocks. We have a few that are as aggressive as 90%. Most of our clients are 60% stocks, 40% bonds. Another decent portion is 75% stocks, 25% bonds. But whatever is right for you was tailored for you and your plan. But this 10% or more decline only happens if you're 100% stocks. So the point of this is volatility is expected, and we know what the average length to recovery is. Market timing can also be very costly. So what this graphic shows us is $10,000 invested between 2000 and up to 2020. If it was left alone, the 10,000 would have grown to 32,000. Now, here's the challenge, is that 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So here, the best days often happen right or close to those worst days. And that's why we can't, try to time the market, right? And our clients know that. Right? If it was as easy to time the market, I could just manage my own portfolio and retire in 5 years, but it's impossible to know, to time the market, to get in and out. And this is that proof. So if you miss that 10 best days, so this is being invested 20 years, but just minus those 10 best days, it cuts your capital in half. So that is a huge risk. If you end up on that side of the equation, you have to really permanently reduce your lifestyle for the rest of your life. So very risky. And actually, conversely, each time that there's a dip, I'm programmed to look at the accounts, take advantage of rebalancing, because I'm hoping that this continues to hold true. It may not always hold true, but it happened with COVID. So we were very aggressive then. We rebalanced to take advantage of the fact that stocks were down, bonds had drifted to too high a percentage of the portfolio. It brought the portfolios back in band according to the risk profile that you'd like, and you acquired more shares. So that's what we're hoping for, is that that this pattern holds. It won't always hold, but you can't go wrong by staying disciplined and buying when there's a decline. So another cost of breaking discipline too, I can think of people I met with during the 08-09 period or 2010 period, where they made drastic changes to their portfolio, and they moved to cash. So this is somebody who was their portfolio was down to about 70,000, and this is something that Vanguard put together. And if they stayed in cash, what the result would have been versus if they would have moved to all bonds, versus, just being 50% stocks, 50% bonds. So, and, I've seen people be on the right side of that equation. I've seen people be on the wrong side of that equation. And it's tough because, again, if you're not participating in the markets and not, you have to participate on, you don't want to, you don't want to end your participation when the markets are down. That is not the right thing to do, right? It's, again, being opportunistic and, again, taking advantage of those declines for your benefit. And then also when the stock market does come back, right? Rebalancing as well, right? You want to rebalance your positions, again, that have drifted out of band, which is what we have done all along. And really having that financial plan and looking at that probability of success. This is an example of a plan of somebody recently, their plan probability of success was 74%. Just by improving their diversification and asset allocation, we actually, their expected return is actually going to drop from 7.15% to 7.07%. So a very small drop in expected return net of fees, but this standard deviation, or how much variability in returns, is more significantly dropping. So that's dropping from 16% to 11%. So again, that diversification lowers volatility long-term, increases the probability of success in the plan. And as you guys know, we like the probability of success to be 85% or greater. And obviously, in addition to the investment mix and asset allocation and rebalancing, there's also other things that drive that probability of success, such as maximizing your income sources, Social Security, pensions, the ongoing tax planning. And if your plan probability of success is 90% or greater, that is okay if you're ultra conservative for your planning. So it's looking at 1,000 trial runs across kind of a standard bell curve of probable outcomes in the market. So really being in some meetings lately, even after this volatility, and people seeing their probability of success and feeling comfort, that's what we want for you, our clients, and that's why you have that detailed plan in place for our planning clients. So in conclusion, couple takeaways here. So avoid at all costs anything associated with the term, this time it will be different, okay? I have not seen a good outcome for somebody who has made financial decisions based upon this thought that the future is going to be dramatically different than what we've experienced in the past. So obviously past performance is no guarantee of future results. We know that, but we're also looking at data that's statistically significant and reasonable. And what else do you have to bet on than that? Keep that long-term in mind, first and foremost. Again, an investment plan, a financial plan is not built for a one-year period. It's not built for a 4-year presidency. It is built for the remainder of your life. So we want to keep that long-term in mind. Turn off the news a little bit. I think it's important to stay informed, but I take a laser focus to making sure that, number one, I am taking it in doses, and I get the information that I feel is the most objective and non-political as possible. But I really would encourage you to try to limit and control and keep that focus on when you do get your information, where and for how long. And most importantly, take some of those opportunistic actions that we talked about that are in your best interest. So, we're here to help you navigate that and identify what actions might be applicable for you, what might help you out during these times, and just know that we're here for you. So we do know that this money has to last you the rest of your life, which is why we go through the detail that we do. So we always, our goal is to we always have a plan. We always act, I believe, with empathy, but also we have to have 100% confidence and 100% plan to address the situation. And so we're here to provide you that. So want to thank you for the trust that you place in us. Very honored and humbled that our firm has grown to the amount that we manage today. It seems like just like yesterday that it was 2011 and I started our own firm with 6 million of assets under management. And so very humbled and thank you and thankful to serve you all. So please let us know if you need anything, and have a great day, and turn off that news just a little bit. Thanks so much. Bye-bye.